While markets obsess over delayed data and government shutdowns, the most profitable opportunities are hiding in plain sight. If you're waiting for perfect information to make investment decisions, you're already too late. Most traders this week are paralyzed by uncertainty. The longest government shutdown in U.S. history has delayed crucial employment and inflation reports. The S&P 500 has fallen 3 straight days. Energy stocks are collapsing as oil hits 4-year lows. Bitcoin dropped below $86,000 for the first time in 2 weeks. But here's what the crowd misses. Uncertainty isn't your enemy, it's your advantage. While others freeze, disciplined investors exploit the predictable patterns that emerge when fear overwhelms logic. Today, I'll show you exactly how human psychology is creating 3 specific opportunities that systematic investors are already positioning for. The current market reveals a fundamental truth about human nature. We crave certainty, even when uncertainty creates the best opportunities. This week's government shutdown has created an information vacuum that's triggering predictable behavioral responses. When visibility drops, risk tolerance contracts faster than logic suggests it should. The 3-day decline in the S&P 500 isn't panic, it's paralysis. Traders are literally waiting for delayed reports to tell them what to think. This is exploitable because markets don't pause for missing data points. They continue pricing in probabilities, often incorrectly. Consider what's happening in energy. Oil has collapsed 22% year-to-date to $55 per barrel, dragging the entire sector down 3.7% in a single day. Exxon and Chevron dropped 2% each. The crowd sees this weakness and assumes structural problems, but second-level thinking reveals something different. The system is creating asymmetric opportunities through 3 distinct mechanisms. First, information scarcity amplifies volatility in both directions. When the delayed CPI report finally arrives Thursday, the market's response will likely overshoot in whichever direction the data points. This creates exploitable mispricings for those positioned ahead of the release. Second, sector rotation is accelerating as capital hunts for catalysts. Healthcare surged 6.7% on marijuana reclassification speculation. This isn't random, it's systematic. When macro visibility dims, money flows toward specific catalysts that don't depend on broad economic data. Third, correlation breakdowns are creating relative value opportunities. Bitcoin's failure to rally with equities after the Fed cut breaks its recent pattern. Technology holds gains while energy collapses. These divergences don't last forever, but they persist long enough for disciplined strategies to profit. History shows humans consistently overreact to temporary information gaps. The 1995 government shutdown, the 2013 shutdown, the 2018 to 2019 shutdown, each time markets initially declined on uncertainty, then recovered as normal data flow resumed. The pattern repeats because human psychology doesn't evolve. Now let me show you the specific opportunities this creates. In energy, oil at $55 per barrel has removed virtually all geopolitical premium from pricing. Yet global supply remains constrained by OPEC plus discipline and reduced U.S. drilling activity. When fear dominates an entire sector, patient capital finds entry points that shorter time horizons cannot access. The Stoic approach here is clear: control what you can control. You cannot control when government data resumes. You can control your response to predictable human overreactions. Energy companies with strong balance sheets and low break-even costs are trading as if oil will stay at $55 forever. This assumption has historically proven false. In technology, the market's ability to hold gains despite Broadcom's disappointing AI infrastructure guidance reveals something important. Capital remains committed to the secular AI theme even as individual data points disappoint. This creates opportunities in overlooked AI beneficiaries that haven't participated in the primary wave of speculation. The bond market is telling the real story. The 10-year yield's persistence near 4.14% despite Fed easing expectations indicates that term premium is expanding. This creates a ceiling on equity valuations that's independent of earnings growth, but it also creates opportunity in sectors that benefit from higher rates: financials, insurance companies, and certain REITs. Here's where most investors make their critical error. They treat uncertainty as a reason to retreat rather than advance. The S&P 500's 3rd consecutive year of double-digit gains has created statistical complacency. Everyone knows this streak is rare. It's happened only 3 times since 1952. But knowing a fact and positioning for its implications are different skills. The crowd reacts emotionally to missing data. we remain disciplined and focus on what the system rewards. Volatility creates opportunity, but only for participants with the process to act when others hesitate. The current environment, characterized by data delays, sector divergence, and asset class decorrelation, favors systematic approaches over emotional responses. Charlie Munger taught us that the best opportunities come disguised as problems. A government shutdown delaying economic data looks like a problem, but it's actually a gift, a temporary edge for those who understand how markets really work. The system doesn't reward those who wait for perfect information. It rewards those who act on imperfect information more skillfully than others. While the crowd waits for Thursday's CPI report to decide what to think, disciplined investors are already positioned for multiple scenarios. This is the essence of exploiting human predictability. When everyone zigs toward safety during uncertainty, systematic value creation happens by zagging toward opportunity. The patterns are consistent across decades because human nature doesn't change. The market will resolve this uncertainty, probably within days. Normal data flow will resume, correlations will normalize, but the opportunities created during this temporary dislocation will have already moved. The question isn't whether you can predict the future, it's whether you can respond to the present more systematically than the crowd. What patterns are you seeing in this environment that others are missing? Share your observations in the comments below. And if this framework for thinking about market uncertainty resonates with you, subscribe for more systematic approaches to exploiting predictable human behavior in markets. Remember, the best time to plant a tree was 20 years ago. The second best time is now, especially when everyone else is waiting for better weather.